Hello and welcome. I am Puneet Wadhwa, and today we have with us Jonathan Garner, Asia Equity Strategist at Morgan Stanley, on the sidelines of Morgan Stanley India Investment Forum in Mumbai. Hello, Jonathan, and welcome.
Thank you. It's good to be here.
Let me start by asking you, Jonathan, regarding the broad indices. Most global frontline benchmarks, be it the Nasdaq, S&P 500, or even the Sensex, have actually gained ground over the past few months, with only a handful of stocks participating in the recent up move. Do you think that the leading indices and the global markets per se are actually trading on thin ice?
I think in Asia and emerging markets, and I would include India in that, we have some features that are quite different from what's going on in the United States and Europe. So in Asia, we never really had the inflation breakout that you saw in the US and Europe. And we've had a return to pretty strong GDP growth. So in India, for example, we've had an upside surprise in the most recent quarterly print, and GDP is tracking for over 6%, whereas in the United States, we've got very tight monetary policy dealing with the inflation breakout last year, and growth is set to slow, sub 1%, which is a much more difficult environment for earnings. So for much of the emerging markets in Asia, we're actually anticipating decent growth, subdued inflation, pretty good earnings, and that speaks to an environment that is quite constructive for stock markets.
So while the environment, as you said, is quite constructive for stock markets, in your March 2023 report, you had upgraded India to equal weight, and the rating has not changed since then. Why is that? And by when do you plan to be actually overweight Indian equities?
Well, if you go back to last October, when we first really changed our view on the overall situation in Asia, we were looking at early cycle cyclicals in markets like Korea and Taiwan, and then China to perform well. China's performance has been somewhat disappointing recently. There, after an initial recovery and growth, activity has slowed. But Korea and Taiwan have done very well for 6-7 months now, as the semiconductor cycle begins to show signs of turning. At that time, we downgraded India to underweight, only really because of valuations. Last October, India was at a record valuation premium to Korea, for example, trading about 24 times 1 year forward PE on Sensex on our calculations, or more than 2 times the multiple of overall emerging markets. But as you mentioned, by the time we got to the end of March, the Indian market had underperformed and it derated in multiple. It's still around 1 standard deviation expensive to its history versus emerging markets, but at the most expensive last October, it was almost 2 standard deviations expensive. And I think the Indian markets can withstand a somewhat expensive multiple given relatively strong GDP growth, subdued inflation, and the fact that the RBI can probably move towards cutting interest rates sometime in the next 18 to 24 months.
Which equity markets across the globe is the big money chasing now? And where is India in the entire pecking order of those foreign investors?
Well, our top pick market is Japan. We've been constructive on Japan for many years, particularly about what we call a productivity and innovation resurgence, and that leading companies are generating much higher ROEs than they used to do. That's to do with improved capex and operating margins, but also better balance sheet management. And these leading Japanese companies, they sell across the globe. And this year in particular, as the US dollar is quite strong and the yen is weak, that's actually helping those corporate margins. So that is our top pick. And then overall emerging markets, as I say, we have certain preferred areas like Korea and Taiwan, but India, we think, will participate in line with the overall emerging markets call, and therefore around about 10% upside from here to the sort of base case targets that we have in mind.
So why is the mood so lukewarm regarding Indian equities? Are the valuations still not supportive?
Well, I think foreign investors, there is this opportunity in Asia to buy Japan and Korea and Taiwan, and they're 3 very large markets. I mean, India will get its share of passive flows into the emerging markets tracker funds. But I don't think there's a particularly, let's say, exciting opportunity to be a contrarian around the valuation situation. The valuations have been very expensive. And many foreign investors understand that there is a strong domestic mutual fund bid here in India from local investors, and that's frustrating for them because it keeps the market relatively expensive.
What are your views on China, Jonathan? We recently briefly touched upon this topic. Some experts actually see some modest returns from the Chinese markets over the next 12 to 18 months, which a lot of people believe that could be a trigger for a lot of money to flow out of the Asian economy. What's your view here? And can China's loss be India's gain in terms of FII money?
Well, for about 2 years, we were quite negative China. If you go back all the way to early 2021, it was on really bubble-type valuations, extremely expensive. And then it went through a long period of economic slowdown, very substantial COVID lockdowns, a lot of regulatory changes that affected the profitability of the private firms in China. So its ROE fell and actually dropped below Japan for the first time ever. And it's probably around 30 to 40% below the ROE of the Indian market. We went constructive China looking for an improvement in economic activity once the economy went into a reopening phase. And the first 3 months or so, that was relatively on track with expectations. But in April and May, Chinese manufacturing data has softened quite substantially. And our view now is that more policy stimulus is needed to actually, in particular, help the property sector to recover in China. So as it is so cheap, it's trading near record lows relative to other emerging markets. We've cut it back to a small overweight position, but we do want to see that policy stimulus before we think foreign investors will re-engage with China. And therefore, our preferred markets are those three that I mentioned, Japan, Korea, and Taiwan, all of which have near-term catalysts. So I don't think it's really a sort of switching between India and China story. It's more than people have switched from China actually towards Japan, Korea, and Taiwan, and that's what's been going on.
How will you approach the Indian markets from now till May 24, when we have the general elections scheduled? These 12 months from here on also have a number of state elections.
Yeah, so we don't comment on politics per se, but obviously we'll be looking at how policies evolve, and particularly what happens to monetary policy and real interest rates that are very important for equity valuations. The economic growth outlook here is pretty favorable, and my colleague Ridham is emphasizing domestic sectors like financials, consumer discretionary, and industrials, and they should do well if our base case sort of 6% plus GDP growth number holds true for the next couple of years.
What are the key risks that you see for the Indian markets from here on out, let's say over the next 6, 12 to 18 months?
I mean, one traditional risk is the oil price, but actually, as we speak today, we've just had an OPEC Plus meeting that has actually cut production, because of the weakness of global oil demand. I touched on that in relation to our relatively gloomy outlook for US and Europe currently. So that's not a constraint on India right now. But I am concerned about the El Nino that is developing and the fact that that may lead to a continuation of or worsening of very hot and dry conditions in India, which could have an effect on the rural sector. So that's something I think we'll watch quite closely.
What are the 3 or 5 big themes in the Indian context that you like at the current levels, or would like once the markets were correct a bit more?
Well, it is really about the domestic consumer and to some extent the industrial development story, and maybe even over time the real estate sector. But you can play the consumer discretionary sector in India in quite a wide range of stocks. We've sort of de-emphasized somewhat for the time being the IT services names and the pharmaceutical names. We think most investors are more interested in tapping into this early phase urbanization and industrialization story, and that's the right way to play the market.
How do you see FY24 earnings play out in the Indian context?
Yeah, so my colleague Ridham does the earnings forecasts, and he's above consensus on FY24. Maybe even in the high 20% EPS growth. And that is higher than consensus. And he's thinking that earnings growth, the 3 years really, 23, 24, 25, can compound at above 20%, which brings down that forward PE multiple, maybe down to only a little bit over 16 times on the outer year, the F25 year.
Thank you, Jonathan, for joining us today. Have a great
investment
forum in Mumbai.
Yeah, it's very nice to talk to you. Thanks very much.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
She's working her way to the corner office. Business Standard.